system. Our trading partners have taken advantage of us. We can see that through the large surpluses. We can see this through the large budget deficits. We are going to move forward so the American people can know that they are going to have a more secure future.
April 4th, 2025, without warning, the U.S. Treasury froze $70 billion in China-bound loans. Within hours, a global bank caved. Trump answered with tariffs. Beijing hit back with digital currency strikes, rare earth chokeholds, and billion-dollar alliances. Markets shook, allies fractured, and the global financial engine veered off course. This isn't a trade dispute, it's a full-scale power shift. And the outcome won't just move markets, it will redefine who controls the future. On April 4th, 2025, the U.S. Treasury dropped a financial bomb. Treasury Secretary Scott Bessent ordered a freeze on $70 billion worth of China-linked loans. These weren't small deals, these were massive global credit lines from top banks in the US and Europe. At first, no one believed it was real, but within hours, a major bank folded. Then another. The pressure was too strong to resist. These loans were tied to China's Belt and Road projects across Africa and Asia. Cutting them off wasn't just bold, it was strategic. A leaked memo to Reuters confirmed it. One analyst called it economic warfare without saying the word. Bessent defended the decision, claiming the U.S. couldn't keep fueling a country working against its industries. But critics warned this could blow back. If America can shut out rivals from global finance, what's stopping others from doing the same? And with one order, Washington may have just triggered a financial chain reaction that could redraw the map of global power. The loan freeze may have hit China hard, but it also exposed serious cracks in America's own system. Just 2 months earlier, Trump rolled out a massive $9 trillion tax and spending plan. It promised growth, but experts say it's built on borrowed money. Moody's warned that the U.S. debt-to-GDP ratio could hit 142% by 2028. That's a level economists call dangerous. Investors took notice. Treasury yields jumped to 4.6%, and mortgage rates climbed past 8.2%. In cities like Phoenix and Atlanta, the housing market stalled. Fitch put the U.S. on a negative outlook, raising red flags about credit risks. Meanwhile, foreign countries started pulling out. Japan dumped $74 billion in U.S. bonds. Saudi Arabia exited another $51 billion. Altogether, central banks sold off over $260 billion. That's not normal market behavior, that's a trust issue. And as America tries to flex its financial muscle abroad, it may be weakening its own foundation at home. China didn't wait to respond. It struck back with a financial plan already in motion. First came the expansion of digital yuan bonds, offering 5.9% returns, way higher than U.S. Treasuries. Countries like the UAE, Singapore, and Indonesia jumped in fast. Then came the twist. China launched redback bonds. These are dollar-denominated but follow Chinese laws, keeping U.S. regulators out. Over $135 billion worth has already been sold. At the same time, China's CIPS payment system, a competitor to SWIFT, grew by 22% this year. Beijing is building a new financial road, one that avoids Washington's toll booths. Experts say this isn't about beating the dollar overnight, it's about giving countries a way out. The dollar still leads, said economist Iswar Prasad, but China is quietly building exits. And the more Washington cuts off access, the more useful those exits become. As the U.S. targeted China's money, Beijing hit back with minerals, ones the world can't live without. In March 2025, China placed strict export limits on gallium, germanium, graphite, and antimony. These rare earths are critical for making semiconductors, EV batteries, and military tech. The impact was immediate. Gallium prices jumped over 220% in just days. U.S. chipmakers like Intel and Nvidia reported delays. The Biden administration rushed to launch Project Stride to boost domestic supply, but it's a slow process. Right now, China still refines nearly 90% of the world's rare earths. That's not just an advantage, it's a chokehold. China also hinted at cutting graphite exports, a key material for EV batteries. Japan started emergency stockpiling. The EU passed a Fast-Track Raw Materials Act. The message was clear. China doesn't just make products, it controls what the world needs to build them. And when it tightens the supply, everyone feels it. While the US flexed its financial power with restrictions, China made its biggest move quietly through its currency. In the first quarter of 2025, the Chinese yuan overtook the US dollar as China's top currency for cross-border payments. According to official data, it now handles more than half of all Chinese trade. The shift didn't stop there. A new report from SWIFT showed that global yuan usage has nearly doubled since 2022, jumping from 3.8% to 7.6%. And Beijing is making sure it keeps rising. Saudi Arabia now prices some of its oil exports in yuan. Brazil is settling soybean deals in yuan. Even Indonesia is using it to trade nickel. This isn't just trade, it's trust being redirected. At the center of this strategy is the digital yuan, already integrated into China's massive payment platforms like WeChat and Alipay. That means countries frustrated with US rules or high SWIFT fees now have a faster, cheaper option. Major European banks, BNP Paribas, HSBC, Deutsche Bank, have already underwritten over $40 billion in yuan bonds this year. And as more countries seek alternatives, China's offer is starting to look very attractive. Economist Mohamed El-Arian put it best: reserve currencies don't collapse, they're replaced slowly, deal by deal. And that's exactly what China is doing. One transaction at a time, it's building a world where the dollar is optional. As the US and China clash, the rest of the world isn't standing still. Many countries are quietly choosing sides or finding ways to play both. In early April, ASEAN members signed a $40 billion regional lending deal with China, aimed at reducing their reliance on Western banks. Saudi Arabia expanded its financial cooperation with Beijing, deepening oil trade and investment ties. Meanwhile, France's President Macron publicly criticized U.S. secondary sanctions, calling them a threat to Europe's economic freedom. Germany, under pressure from both the U.S. and China, chose to abstain from any direct action, fearing backlash from its automakers tied to Chinese EV supply chains. India also made a big shift, settling more trade in rupees and yuan, especially for metals and energy. Even traditional U.S. allies are hedging their bets. At the global level, the IMF warned that the world may be entering a period of currency fragmentation, where more countries use multiple currencies instead of just the dollar. It could raise volatility and weaken financial stability, said the IMF chief on April 9th. The world isn't splitting in two, but it is reshaping. And every new deal signed outside the dollar system makes it harder for Washington to stay at the center. Beneath the headlines of loans and sanctions lies another battlefield: electric vehicles. On March 27, 2025, the U.S. hit Chinese EVs with a massive 145% tariff. The White House called it a move to protect national security and stop unfair subsidies. But behind that was panic. Chinese EV makers like BYD, XPeng, and NIO are growing fast, and they're cheaper, smarter, and already outselling Western brands. In fact, BYD just passed Tesla in global sales for Q1 2025. The US ban shut Chinese EVs out of the American market completely, but the fight didn't end there. China slashed EV incentives for US automakers operating inside China, hitting GM and Ford hard. Europe is now caught in the middle. Germany opposes a full ban because Volkswagen depends on Chinese battery tech. At home, US automakers are struggling. Battery costs are up 18%. New EV models are delayed. Consumers are seeing higher prices, and as the EV war heats up, it's not just about who makes the cars, it's about who controls the future of mobility, energy, and the supply chains that power them. This isn't just competition, it's a global tech war, and it's moving fast. What started as a $70 billion loan freeze has revealed something much bigger. This isn't a trade dispute, it's a controlled decoupling of the world's two biggest economies. The US is using access as leverage, China is building its own lanes, and now trust, money, and influence are all moving in new directions. The global engine is being rebuilt, one bond, one battery, one bank at a time. So ask yourself, is this bold strategy or a dangerous overreach? Can the US isolate China without isolating itself? And is the dollar losing ground or just facing its first real rival? Drop your take in the comments, we're reading every one. Hit like, share this video, and subscribe for deeper dives into the power plays shaping tomorrow's economy. This isn't over, it's just getting started.